All right, so now we're looking at the regression table, and just looking at what was the best performing portfolio for February, and it looks like well, this was the best performing one, dividend and alpha, and what that simply means is it takes the largest dividend stocks and it marries it with the alpha, and the alpha is how well the stock performs when the market is performing well during an uptrend. And so, it's one of those times that the scoring system works perfectly. It makes all the sense in the world. Of course, the market is in an uptrend, and we saw people running into those high dividend consumer durable good stocks. And what that says to me is that you have a lot of money coming back into the market, but you have a lot of people that's also scared. They're afraid that at some point the market is going to fall, and so they're looking for protection. Over the past couple months, we see here that the equal weighting, which I don't know how that happened. Just let's see if I can find the second best one. Yeah, see, alpha and down, and so that's talking about basically stocks with the best that perform the best when the market is in the uptrends, and it marries that with companies that tend to perform. What's the word I'm looking for? It's the opposite of companies that perform worse when volume is high. It doesn't mean that they perform well when volume is high. Okay, I can't explain it right now, but either way, that was really the best performer. That equal weighting, that is literally an outlier. But you see here, last month it was alpha and standard deviation, right? Pretty much the same thing as alpha and down, very close anyway. But see, now the market is going a different direction. See, now we have dividend stocks married with the alpha. So that means that we're going to see a downturn, right? It's going to happen. People are planning for it, they're expecting it, and typically whatever you think you'll do. So if people are running this and people are thinking it's going to go down, it's probably going to go down. So whatever I do for their technology pick, for right now in the short term, we definitely want to look at something with a larger dividend, which of course is SEAGATE. But let's do a count here, and let's see how many orange blocks we can pick out. Okay, so we got SEAGATE 1, got Intel 2, Microsoft 1, Intel 3, Intel 4, SEAGATE 2. Wow. Intel 5, Intel 6, Texas Instruments 1, Intel 7, Intel 8, Texas Instruments 2, SEAGATE 3. I mean, you can't deny that. I mean, Intel is all over this thing, man. Let's count them again. 1, 2, 3, 4, 5, 6, 7, 8. 8 times Intel showed up in the best performing portfolio. Just for fun, let's do this. Let's pick out the months in which Intel performed the best. let's see. I'm gonna have to do it this way. Let's see here. Is that gonna work? Huh. Nah, it's not gonna work. Let's see what else I can do. Well, yeah, okay. That might work. Hope I can remember to go back and fix that, right? You got this one. This one. This one. This one. Okay. Let's go and look and see what months it performed the best and why. And we can see here. Oh, no, that's not gonna work. Well, maybe, because it'll show me. There we go. All right, that works. Okay, so yeah, it's got up and down, which I'm gonna call that an outlier. It's never performed the best, but that's just the difference between up and down. Let's see here. Alpha standard deviation. So again, we're talking about an uptrend in the market. Dividend and down. Okay. Performed well with the down moves. Performed well as far as volatility. That's the standard deviation here. It was in this portfolio again under down moves. I'm gonna have to look into that now and really see what's going on there. And it looks like the next one, and it was part of the equal portfolio. My goodness. And it looks like yeah, alpha standard deviation. So it's part of all those groups that are moving higher when the market is in an uptrend. And so we have been moving higher. Of course we have. From the lows of January last year. Yeah. From the lows of January. Let's take a look. Let's see. Let's go to our results, and let's look and see what we have. Let's blow this up. All right. Way over there. All right. So, about that. January, what I'm going to do is I'm just going to pull a quick average just to see what the difference is between the market in January, which the average was 49, and see what the average is now for February. See if it's higher than 49. The average, oh, that's right. There we go. It's going to make me do that. Oh, really? That's fine. That stock is not around anymore anyway. I need to figure out a way to take that out. Okay, here we go. 55. Look at that. 49 to 55. 56 if you round up. So we're talking about the market has moved quite a bit from then till now. So of course, we're going to be looking at stocks with a higher alpha, stocks that are moving when the market is doing well, to give us a great return. And that's what we've seen. And so the question is will that continue? Is that the best way to position the portfolio? What I want to look at really quick is how I have calculated the down moves here. And oh, you know what? That's actually in another file. But I can do this though. I can check how it's scored. So it's W. Come on. X, Y, Z. Okay, so it's Z. So let's see. You see here for Z, I am subtracting. That's what I thought. So what that means is it is exactly what I thought it meant. So when the market is when there's a lot of volatility in the stock tends to go down, right? And so if you put a negative in front of that, it means the exact opposite. So this is a company that is going to go down less when there's a lot of volume in the stock or a lot of activity in the stock. It's going to go down less. Not necessarily go up more, just go down less. So with that being said, let's take a quick look at what that number is for Intel. C-Tech. All right. Here we go. So just want to look at this by itself here. You know, that's gonna turn me off right away. It's gonna be very hard for me to leave something I'm getting a 6 or 7% dividend out of to move into something that only gives me 2.8, maybe 3. With that being said, the rest of the sector is about 3 as well. Let's see. Yeah, the average is 3% for the rest of the sector. SEAGATE is kind of hanging out there by itself as far as dividends are concerned, which again gives me a bit of pause. It really does. But it's been a great company so far. Very volatile though. If we see here, look at this. See, look, 13%. That's probably the highest volatility out of any stock in our basket of stocks for this entire portfolio. I mean, that's up there. So I really have to do some real soul searching to see how we're going to proceed, because getting rid of that dividend, it's going to be hard for me to do. And the question is the dividend safe? Well, in the short term, yeah, of course it's safe. But can I say that for a year out? Can I say that 2 years out? Well, no, I can't. I don't know. There was a lot of talk about cutting the dividend about a year ago, and I was convinced that either they weren't cutting it, or if they did, it wouldn't matter because it would still yield about 4 to 5%. So that's where that is. Okay, let's take a quick look here at purchase price and current price. Looks like everything has gone up. Everything. Nothing stayed the same except for Intel. Intel has pretty much stayed the same. Hewlett Packard looks like it stayed the same, but something tells me that based on price, you look at the percentage, is actually going up quite a bit more than Intel. So, man, this is difficult. The return on Intel, though, 1.28 a month, and I have to wonder how does it go from 34 to 36, but you're telling me the average increase is 1% a month. That's almost doesn't make any sense, right? Volatility is still a bit high for Intel. The PE ratio, I'll say a bit high for these stocks, right? Cisco, Qualcomm. It's going to be in the same company as Intel. Microsoft, Hewlett Packard, not in the same place. Definitely not Seagate. They do completely different things. Let's see. Net profit for Intel's 10%. Seagate, the profit is falling quite a bit, but again, that stock is so volatile that a little bit of good news drives it way up sometimes. Qualcomm's losing. Texas Instruments really kind of, well, Cisco's there too, so can't say it just killed them, but 18% is really, really good for this sector right now. All these guys have plenty cash. Seagate, looks like Seagate and Hewlett Packard are the only ones really lacking. Everyone else has plenty of cash on hand. Same thing there. Texas Instruments. MXIM, never really been on my radar. Don't know a lot about them. Let's see. Everyone is losing assets or piling on liability except for Texas Instruments. And how many times have I said Texas Instruments so far? See, cap costs really low for a lot of these guys, but again, they're in different businesses. So Seagate has a cap cost because they're actually making things and holding things. A lot of these companies don't have the same type of inventory as Seagate, so it makes sense that their debt would be they wouldn't use as much debt. Texas Instruments, Cisco seem to be about the same. Qualcomm about the same. Let's see the beta on this thing. Texas Instruments, I mean, blows everyone else out the water for beta, except for this guy. So that really says a lot. When things are bad, Texas Instruments is doing really well. Let's see where everything is. All right, so let's see, expected return. Texas Instruments scores the best with CA at a close second. And it looks like Intel is 22% away from its high. And I have it at, see, now I gotta go back. I had it at 46. I have Seagate at 44. And Seagate has blown past my high target. So, I mean, I gotta take some money, no doubt. Intel 46 though is currently It's currently 22% away from that. So that means it's not, compared to the rest of the sector, it's not even close to its high mark. Does that mean that it has opportunity to really break out and scream higher? With the market being in an uptrend like it is, you think so, right? Seeing people pile into those dividend defensive plays gives me pause to just run with that, though. Intel is 51% off its low. SEAGATE, my goodness, 2% above what I had it at, 82% off its low. That is a big jump. Hewlett Packard, I mean, almost there. Texas Instruments almost there. So it looks to me that everyone in the sector is really close to their targets. Intel is the only one that has any kind of room to run. Microsoft actually has hit a brand new high that it's never been this high before, and it still has room to run according to my estimates. So that's something that we'll have to look at as well. Let's see, the alpha on Intel, negative 4.3, best in the sector though. Now this is interesting. When there's a lot of activity in the stock, this thing is going up 31% of the time. Conversely, it is the best in the sector when there's a lot of activity in the stock. It is only moving down 23% of the time. Half the time, there's not a lot of volatility in the stock. And I think that also says a lot about a stock as well. You know, when you have something like this, where 73.8, that means that 81% of the time there's constant activity. I mean, there's always new activity. You know, that could be sign of trouble. It could be sign of exuberance. You don't know until you look into it. But that's a great number though, you know, and that's why it has performed so well over the last year. Let's take a quick look again at the table here for Intel's performance. Here we go. So 1% puts it at second best performer in the sector. I mean, man, you know, there's a lot of good things I can say about that. So what I'm definitely going to have to do is I'm definitely going to have to do some reading and go through some news articles, take a look at the last earning call, and just see kind of what's in store for Intel before I can make a decision on whether or not to dump Seagate and go into Intel, or at this point, maybe even Microsoft too. You know, Texas Instruments scores the best. It does, but it's just, man, it's hard. Go back and look at. Go back and look at Texas Instruments. Yeah, best score. Beta is great, but right now, do we need beta? I mean, again, the question goes back to, is the market starting to turn over, or are we going to continue on this uptrend, right? It looks like for now, in the short term, yes, we're going to continue on this uptrend. We're going to keep grinding higher, from what I can tell. So, yeah, let's do some research, come back to it, and make some decisions. I holla. Okay, so I went back and I looked at all my numbers, and I came to a conclusion. Something that you know, I always have to come back to is the difference between short term and long term, and to trust my program, to trust my system. And so I'm looking right now at the portfolio that has the highest total return thus far, and it's alpha and down, and that makes a lot of sense because these particular stocks are going to perform very well when the market is in an uptrend. However, long term, over the course of the time that the system has been up and running, it has been, as soon as I get to it, alpha, beta, there we go, yeah, beta and standard deviation. This is currently the portfolio that we're following at the moment, and so I'm going to stick with that. And with that being said, Texas Instruments is actually at the top of that list. I did a little bit more research. I'm happy with the company. I know that I'm losing on a lot of alpha. I'm losing on a lot of return. But in keeping with my system and my program, the way it's set up, I think it's more important, and to have patience because, in June, all of this is going to change. And we'll be looking at these numbers again to find out which portfolio performed the best, and then we'll be looking at that one. And right now, it looks like return standard deviation is a little better. Even down here at the end here, we have the beta return standard deviation, things like that. So who knows what it'll be in June, right? But whatever has the best long-term performance is the portfolio that we'll roll into. But for right now, we're going to stay with the beta and standard deviation. And, I can be happy with that because when the market does take a dip, those companies will fare very well and may actually give us some return. So, dropping SEAGATE, moving into Texas Instruments, and I'm happy with that. Holla.